Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adenoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome back to the Deep Dive. So you've given us this huge stack of sources covering the crypto world at the end of November 2025, and wow, it seems like a period of just total extremes. On one hand, you have this institutional fear, but on the other, these massive technical and regulatory leaps happening all over the globe.
It really was a pivot point, and our mission today is to cut through all that noise and really just pull out the few key things you need to understand from this moment.
Okay.
And we can confirm, while all this innovation was happening, the market sentiment was mixed at best. Those big price rallies everyone was waiting for, definitely not happening. We need to look at the structure, not just the headlines.
Okay, so let's start with where the real pain was, which seems to be with the institutional money. I mean, we have to unpack this gloom because the numbers around the ETFs have gone from just bad to, well, way worse.
That's exactly where we need to start. The sheer scale of the outflows is it's hard to ignore. It really points to institutions pulling back, de-risking.
How bad are we talking?
Well, just since the last major trading day, we saw outflows cross $1 billion. And that pushed the total for the last 2 months to over $4 billion leaving these ETFs.
$4 billion. That's not just a fluctuation, that's a retreat.
It's a clear institutional retreat. And when you dig into the numbers from November 21st, it gets even more interesting.
Okay, so what did that day look like?
The total outflow was about $1.05 billion, but the distribution was really uneven. Ethereum ETFs saw a huge outflow. We're talking 693.5 million.
Wait, 693 million? That's way more than Bitcoin's.
Just almost double. Bitcoin's outflow was 355.5 million. And that really begs the question, why is Ethereum getting hit so hard by this institutional panic?
Yeah, what's the thinking there?
It's the hidden story, right? It suggests that big money is rotating away from assets they think have a higher regulatory or, technical risk.
So even after the merge, they're still nervous about Ethereum's proof-of-stake model.
In the eyes of some regulators, yes, there's still some uncertainty. And it could also be simple profit-taking. Maybe they're hedging against the broader market, or, and this is key, they're rotating into newer things they feel they missed out on.
But you said there were a couple of bright spots in all this red, right?
A couple of small green shoots, yeah. Specifically in the newer ETFs.
Yeah.
The Solana ETFs pulled in about $23 million.
Tapping into that whole ecosystem's excitement.
Exactly. And the XRP ETFs, which had just launched the week before, had a really strong start, 118 million in inflows. It shows that institutional demand isn't dead, it's just being incredibly picky.
So selective rotation, major fear. What did this actually do to the price of Bitcoin?
Well, in just 6 weeks, Bitcoin fell by over $40,000. It's hovering around $86,951 right now.
Ouch.
Yeah. But for people who watch the market closely, the price is almost less concerning than the activity happening underneath. For me, the real indicator of market health is stablecoin volume.
Okay, explain that. Why is that the alarm bell for you?
Because stablecoins are the lubricant for the whole crypto economy. They're what traders use to move quickly, to take risks.
The oil in the engine, basically.
That's a perfect way to put it. In a healthy, active market, the 24-hour volume of just USDT should be somewhere between, say, $180 and $200 billion.
Okay, and where are we now?
We're at 87.62 billion. I mean, it's less than half. And that doesn't just mean fewer trades are happening. It means less active usage, less liquidity. It's the sound of capital just sitting on the sidelines, refusing to play.
So capital is on the sidelines, but there's one little area that's actually booming against all this
The
fear.
privacy coins.
Right.
Zcash specifically was up well over 10% in just 24 hours. And that jump, that's a direct reflection of this massive debate that was raging at the time, the Bitcoin privacy and security showdown.
Okay, let's get into the drama here. This whole thing was kicked off by VanEck from Zaxio, who basically claimed Bitcoin's encryption might not be strong enough for the future.
And he's pushing Zcash as the alternative.
He is. He's suggesting that long-term Bitcoin holders are starting to look at Zcash for better privacy. It feels like a direct challenge to Bitcoin's whole philosophy.
It is a challenge, but, one that the maximalists are fighting back on, hard. We have to break down VanEck's two main points. First, security.
Right. He's worried about quantum computing.
Exactly.
Yeah.
He's saying that Bitcoin's encryption, which is industry standard elliptic curve cryptography, could be vulnerable to future quantum computers.
So what's the rebuttal to that? Is that a real fear?
The consensus is pretty clear. Bitcoin's current encryption is still incredibly secure. It's not breakable by any quantum computer that exists today.
Okay.
And most experts agree that a machine powerful enough to be a threat is years away, maybe even decades. The immediate risk is mostly, just fear-mongering. Bitcoin can and will be updated long before it's a real problem.
So the security risk is maybe premature?
Yeah.
But what about the privacy side? VanEck is basically saying Bitcoin's transparency is its biggest flaw, and that's why people are looking elsewhere.
And this gets to the very core of the philosophy, right? Is transparency a feature or a flaw?
Yeah.
Bitcoin is transparent by design, so that anyone, you, me, anyone, can verify every single transaction and audit the total supply without trusting some bank or government.
That unmatched auditability.
It's one of its most powerful features. The fact that the entire history is public is what stops people from just creating fake Bitcoin out of thin air.
I get the institutional argument for that, but isn't that same transparency a weakness for the average person? I mean, we're about to talk about that UK crackdown, and they track billions of dollars because of that transparency.
It's a fantastic point, and it's why this isn't a simple debate. But people who say Bitcoin has zero privacy are usually just not aware of the tools that already exist on the network.
They're confusing transparency with a total lack of anonymity.
Exactly. When you use it correctly, you can still have a high degree of privacy.
So give us a quick rundown of those tools.
Well, you have things like CoinJoin, which mixes transactions from multiple people together, making it incredibly hard to tell who sent what to whom.
Okay.
And then you have the Lightning Network, which handles a ton of small transactions off the main chain. It sort of bundles them up, so most of the details are kept private. These tools solve most of the casual privacy concerns people have.
So what's the main knock on Zcash then, the alternative that VanEck is so excited about?
Well, Zcash has some really pioneering privacy tech, no doubt. It uses something called zero-knowledge proofs. But its big weakness, its Achilles heel, is that it relies on a trusted setup.
A trusted setup. Break that down for us.
Okay, so in the very beginning, a small group of founders had to create these secret cryptographic keys. And the trust part is you have to believe that after they created them, they completely and perfectly destroyed them.
Because if they didn't.
If those keys weren't destroyed properly or if they were ever compromised, then the people who have them could theoretically create fake Zcash without anyone knowing. It undermines the entire privacy guarantee.
That's a huge amount of trust to put in a small group of people for a supposedly trustless system.
It is. And you add to that, it's smaller adoption, less liquidity, less infrastructure. It's just not realistic to think of it as a replacement for Bitcoin's role as this global store of value.
And is there any actual data showing this mass migration he's talking about?
Not really. Despite all the headlines, there's no meaningful on-chain evidence that long-term Bitcoin holders are actually switching to Zcash in any significant numbers.
So while everyone's arguing about philosophy, some of the chains themselves are running into very real, very technical problems. Let's switch gears to what happened with Cardano on November 21st, a temporary chain split.
Right, and we should emphasize temporary. Thankfully, no one lost any money, but it was still a major disruption. The issue was a badly formed transaction that exploited an old bug in the software.
And what did that actually do to the network?
It basically caused the blockchain to split into two separate chains for a short time, two different versions of history, which is, a nightmare scenario for any layer one.
And we know who did it.
A staking pool operator called Homage. They came forward and claimed responsibility, but they said it was an accident. Said they were using AI-generated code to test something, and it went wrong.
Wait, they split a major blockchain with AI-generated code by accident?
That's what they claim. And it raises this really chilling question, right? If negligence with some untested AI code can do this today, what does that mean for the security of all of these networks tomorrow? It's a whole new kind of threat.
Absolutely. So the developers had to scramble.
And they were very quick. To their credit, they pushed out an emergency update, a hard fork, version 10.5.3, to fix the bug and merge the chains back together. But the founder, Charles Hoskinson, he called it a premeditated attack and said they're investigating. It was a serious stress test for the network.
So while developers are fighting bugs, law enforcement is out there using crypto's transparency to their advantage in a huge way. Let's talk about that UK crackdown.
Yeah, this story is just incredible. The UK's National Crime Agency uncovered a $1 billion money laundering network. $1 billion, operating across 28 cities in the UK.
And what was the method?
They were collecting dirty cash, from drug sales, firearms, all of that, and then using this network to convert it into crypto.
But the scale of it is what's just mind-blowing.
It really is. It connects local street crime to the highest levels of international finance. This network actually went and bought a legitimate bank in Kazakhstan.
They bought a bank.
Bought a bank, all to help Russia evade sanctions and fund its war. It just shows you the level of sophistication we're dealing with.
So what were the results of the crackdown, and how does this tie back to that privacy debate we were just having?
The results were huge. In less than a year, 128 arrests, and they seized £25 million in cash and crypto just in the UK. And this is where that transparency point becomes so important.
Right.
Because law enforcement from the UK, Ireland, the US, they're all collaborating. And Bitcoin's public ledger, even with criminals using mixers, actually makes it easier for them to follow the money and dismantle these networks. For regulators, transparency is a weapon.
A powerful reminder that auditability cuts both ways. So, speaking of market shifts, it seems the big centralized exchanges are paying attention, which brings us to Coinbase's recent acquisition spree.
This is a massive signal about where the future is headed. Coinbase just acquired Vector, which is an on-chain trading platform built entirely on Solana.
Okay, so why Vector? Why Solana?
Well, Solana's ecosystem has been growing like crazy. It passed $1 trillion in trading activity this year because it's so fast and cheap. So Coinbase wants a piece of that action.
And this gives them an instant foothold.
An instant foothold. By bringing in the Vector team and their tech, Coinbase can offer its users faster trades, better liquidity, and direct access to all the new tokens popping up on Solana.
So what does this move tell us about the future of crypto trading itself?
It's a huge trend. Centralized exchanges are finally embracing decentralized on-chain trading. I mean, after the whole FTX collapse, users are demanding self-custody.
They don't want to trust exchanges with their money anymore.
Nobody does. And for a giant like Coinbase, buying a platform like Vector is just a shortcut. It's way faster than trying to build this complex technology from scratch, and it keeps them competitive.
Okay, now let's look at where that future is actively being built, which increasingly seems to be the Middle East. Tell us about what Saudi Arabia is doing with real estate.
This is genuinely a monumental achievement, not just for the region, but for the whole world. The Saudi Real Estate General Authority, REGAR, completed the first ever real estate tokenization, completely under government oversight.
But that's not the real headline, is it?
No, the real headline is that in doing so, they have established the world's first official regulatory standard for property tokenization.
The first official standard. That's the kind of regulatory clarity everyone's been begging for. Why is that so important for real estate?
It's all about liquidity. Tokenization solves this huge problem of how to divide up incredibly expensive assets like a skyscraper or a shopping mall.
Right.
It turns these massive illiquid buildings into tiny, affordable, tradable digital shares. It opens up the market to a much wider pool of investors and just speeds everything up. By setting the standards, Saudi Arabia is basically telling the world, this is how you do it legally.
And while they're digitizing physical assets, Dubai is all in on integrating AI into its government.
All in. The Dubai Ports Authority just launched an AI-powered smart permit system. It uses AI and robotic process automation, or RPA, to automatically issue work permits for all sorts of port activities.
That has to be critical for a place that busy. What kind of volume are we talking about?
It's handling around 44,000 transactions a year, and it covers really complex stuff like permits for dangerous goods, vessel refueling, ship repairs, you name it. It's all part of Dubai's big push to use AI to cut down on processing time, get rid of human error, and just make everything safer and more efficient.
We have covered so much ground today. I mean, from the market gloom and those big institutional outflows, especially from Ethereum, to this really deep philosophical debate about Bitcoin's privacy versus its transparency. We saw a major network fail because of some bad AI code. We saw law enforcement take down a global criminal enterprise. And then we pivoted to these incredible forward-looking steps in the Middle East with tokenization and AI.
And that contrast is just the reality of this industry, isn't it? The market volatility gets all the headlines, but in the background, this foundational work is happening. The kind of stuff Saudi Arabia is doing, creating that first legal framework for tokenization. That is a huge indicator of where the next big narrative is headed in 2026.
Away from pure speculation.
Away from speculation and toward the real-world use case of digitizing and fractionalizing actual assets.
And the entire market, like we saw with Coinbase buying Vector, is admitting that the future of trading is on-chain. It's moving away from those old centralized systems. So if that trend continues and users keep prioritizing self-custody and on-chain speed, which of the big exchanges that refuse to adapt, the ones that just stick to the old way of doing things, will be the first to start bleeding users and lose their edge? That's the strategic question everyone in that space needs to be thinking about right now.